we'll get going. All right. Good afternoon, everyone. Morning for some, evening for others all over the world as we begin our live trade session for today, of course, July 20th, in the brand new spanking year 2020. And why do I say it's brand new spanking year 2020? Well, I heard a funny joke this week about the new norm for for calling something crazy. I think we've all heard the term somebody went postal, or that's something sounds like it went postal. Well, the new term is somebody went 2020 on you. So that's the new term for crazy. So nonetheless, I diverge. We got a lot to cover today. Enough of that. As we get closer to the seminar date, which is in less than 2 weeks now, starts not this Friday, but the next Friday. I continue to prepare and put things together that is absolutely going to be tremendous material and information that will allow you to better take advantage of these opportunities and obviously to understand the opportunities. And I'll talk a little bit more about that as we go. But if you have not upgraded yet, man, time is running out. And so give Spring a call to do that. And the Triple Play Options 2-day online seminar will cover Triple Play option patterns, and there will be several that we go through, and several templates and various market conditions for these patterns. And then we'll also be talking about TPO, profit stacking, and enhancing trades. And so it's going to be just jam-packed full of information, but it's going to be a little bit different than maybe a lot of seminars that you have gone to in the past, which jam a bunch of information into a short period of time. But the problem is that you leave confused and you have no clue where to begin, how to implement any of it. And so within this seminar, I have been slightly changing some things and adding some things and changing how I go about presenting the information based on your feedback from these calls, based on the questions that I'm getting from these calls. And so what I've done is I've put together an extensive step-by-step blueprint for the TPO seminar. And I started doing this with just the $1 million pattern, which is what I call the pattern that we've been focused on the last several weeks, actually almost a couple of months now. And I made a template for that, a blueprint for that, if you will. But this blueprint for the TPO seminar is from start to finish. How do you implement each piece of the information that you're given in there? And so I know a lot of you wanted me to provide the sessions early, and I specifically didn't want to do that until I was settled on on everything. And I'm glad I didn't do that, because this is kind of where it's morphed, is to make sure that I don't just give you the information, but I give you a very straightforward step-by-step plan on implementing every piece of it. And so the way that it's now laid out is that that you will graduate as soon as you are successfully implementing one piece of information. Then you can add on the next piece of information, or then you can add on the next piece of information, or the technique, if you will, the next technique for improving your overall results, probabilities, efficiency level, et cetera, et cetera. So so now that is the direction that this is taken. I think it's going to be even better than when I first started talking about it. So that's it. I'll be done pitching the seminar. For those that are new on the call, I do want to welcome you. I don't think we have too many new people on today's call, but if you are new on the call, I just understand that I don't explain everything about these trades on the call. It's impossible for me to explain everything about these trades on a single call when we're talking about, okay, what do we want to do right now? What are we looking at today? What are we focused on today? And so I do explain some things, but not with the purpose of explaining everything. So if you are confused by the end of the call, that's fine. You're not alone. Most everybody, the first time that they get on these calls, they're confused at the end, but you just keep exposing yourself to the information and to the logic, and believe me, it will click and you will understand in due time. You should understand enough to realize, okay, this is definitely something I need to focus on and spend some time on. So with these trades, if you're new, I do want to give you a warning. They are fantastic trades, but there are some gotchas. There are some traps. And so while I explain these traps, a lot of times traders, it doesn't really ring a bell until they actually do something to get caught in one of these traps, and they're like, oh, that's what he meant. And so you don't want to do that with a large account. You don't want to do that with a large trade size. You start small. There's plenty of time and plenty of growth available once you start realizing success. Number two, don't be reckless with how you put these together. And this is one of the things I'm going to be focused on today, because I say this every single call, but there are some trades that I saw over the weekend. Some of you were kind enough to send me exactly what you're doing. There are some situations I saw that you're falling into a trap, and it's because you're not paying close enough attention to these traps, and you're just kind of throwing a bearish and a bullish that looks good together, and you say, oh, well, it's a great trade. Well, it's not so fast, right? So you can't be reckless with how you put these things together. You have to be very, very intentional, and you have to know where the traps are to help you avoid them. And then number three, you need to follow the instructions. If you don't follow the instructions, you will eventually get smacked. And I'm telling you from experience, even if I don't follow the instructions, eventually I will get smacked. All right. So you like that terminology? We're real educated here on this call. All right. So money management. Let's talk about the compounding real quick. Again, I do this every single call, and some of you, it's like redundant, but I do it because it has to be your focus. If this is not your focus, you'll get distracted with all the other trades and all the ways of doing different things, and you need to constantly be reminded to simplify. And the reminder is that I'm not trying to make a killing this week. I'm not trying to make $1,000 on a trade. I'm not trying to trade so big this week that I double my account one week. I tried that and I got smacked. So with the account size, with any small account, you can do it with $1,000, $2,000, $5,000. It doesn't matter, as long as you make sure that the trades that you're taking don't give you a high probability of diminishing the account size over the course of 5-6 weeks. But if you're risking $150, if you're not risking any more than $150 on any given trade, and you have a fairly low probability of realizing that $150 max risk, then you can start with $2,500 in your account easy, because even if you suffer that max risk 10 times in a row, which you're not going to, because if you suffer it 3 or 4 times in a row, you're doing something wrong. Right? So that gives you plenty of room for error, plenty of room to make mistakes. And then finally, when you start to turn the corner, you can, you still have enough money to, keep going. And so with the compounding, as soon as you start to realize some gains and you increase your efficiency and whatnot, if you can get to where you're making $100 a week, you're talking about astronomical growth in a short period of time. 6 months, it's $30,000 of profit. If you are able to average that over the course of 5 years, you're talking about over $3.3 million, almost $3.4 million. And there are ways to dramatically increase that through a few changes in the money management approach or the compounding approach, which I'll talk about more in this seminar. So keep this as your focus, because that's what's going to create the wealth, not these not creating the most incredible, spectacular, risk-free trade you can possibly create. Yes, increase your efficiency, but you can definitely get sidetracked and distracted by trying to overdo these trades. So I try and keep the focus on what's going to make you the money. All right, having said that, my goal with each one of you and in these sessions is always the same. And my first and foremost goal is to get you to where you're experiencing some sort of consistent profits. And it can be very distracting, when I'm going over the different things and different strategies and different techniques and whatnot. And I think that's where this will help. The seminar will help greatly, and the blueprint will help greatly. And if you're wanting to start the blueprint now, you can start the blueprint that I sent out a little over a week ago now, and you should have access to that. It's called the 98% Probability of Becoming a Millionaire Blueprint. A nice short title, right? So you can start following that blueprint immediately. But what I received, a couple of questions I received in the last session, and then I had y'all send me the trades. Yeah, I was noticing something with the few that did send me their trades, a common mistake. And that common mistake was that they were not putting themselves in a trade that gives them a high probability of being able to exit the trade at a profit early. And if there's any indicator of a trap trade, if you will, it's that it never shows a profit until the very end. That one is often a trap trade. So when we're putting these trades together, we're hoping to put these trades together so that there are multiple exit opportunities throughout the week. For example, last week we could start, we put on a trade on Thursday, not last Thursday, but the Thursday before. We put on a trade on Thursday, put on a similar trade on Friday. We were able to exit that trade profitably for a small profit on Tuesday. And on Wednesday, by the end of the close, there was a $65 profit. And then on Thursday, after volatility came out, the announcement came out, we were still able to exit at a $50, $55, even $60 profit at some points during the day. And then on Friday, all day long, you were able to exit at a $50 profit for most of the time. A couple of times it went above that, a couple of times it was slightly below that. But there are many, many opportunities to exit at a profit based on the market movement, up, down, and it's basically a time thing. And that's one of the benefits of the $1 million pattern, is it does provide multiple exit opportunities. So you need to stay away from the trades that only provide a profit potential right before the close on the last day. And you can make a trade that is more likely to exit at a profit if the market moves down, or you can make a trade if it's more likely to exit at a profit if the market moves up, etc. But there are trades where it doesn't matter whether the market moves up or down. It doesn't matter whether you're in for 2 days, 3 days, 4 days, 5 days. There are not very many profitable opportunities to exit. And that is the issue. And this can be super ridiculous, super tricky sometimes, because of how ridiculous some of the volatility drops that occur on both Thursdays now and Fridays. And especially after the first few hours of trading on Friday. Now, let me explain to you what's going on, because it is different than it was a little more than a month ago, about 6 weeks ago, 7 weeks ago. something fundamentally changed about 6 weeks ago. And that was the massive uh, surprise that occurred in the every Thursday morning unemployment report. And there was a massive surprise, and the market shot up, opened up like 10 points. That's when I didn't follow my own instructions, and I took a hit on that. And so the market opened up 10 points, and ever since that time, the volatility has been very high, relatively speaking, on Monday, on Tuesday, and even on Wednesday. And then it drops off Thursday morning when there's no big surprise in the unemployment report. It didn't used to affect the volatility. The Thursday reports didn't used to affect the volatility the way it does, but that's what we're dealing with right now. And so that's why these math calculations they will not be right. They cannot and they will not be right because they cannot take into account the fact that there's a news event, an economic report on Thursday morning now, and that on that uh, at the release of that news event, the unexpected, or I shouldn't say unexpected, the uncertainty is now removed from the market, and they begin to drop the volatility immediately on Thursday. So it is different than what we have experienced, and this is why some of you are getting into situations where it looks great on Thursday a week before, Friday a week before, Monday of the same week, sometimes even Tuesday of the same week, and then all of a sudden on Thursday it looks awful. And that's because the math calculations are simply math calculations. They are not taking into account fundamental issues that are going on affecting the market, okay? So here's my suggestion for you. As you're putting these together, you're learning how to put these together. You're going off on your own, and you're saying, "Oh wow, this I'm going to use this bearish trade, and I'm going to add this bullish trade," and that's great. That's great that you're doing that. But don't ever, ever take a trade that you do not know how it's going to react throughout the week. Okay, if you have not seen it here, if you have not seen it in your own research and trading, do not take it. Don't just put together a trade and say, "Oh, I found this great trade," and then beep, trade it. Don't do that. That is a no-no, and that is something that I know a lot of you have done. That is not how we go about putting together these trades. So here is an example. I'm going to go through the process for you. And this is a trade that is similar to one that somebody sent in and said, "Hey, I've got this great trade. There's no risk to the downside. There's no risk to the upside. There is a dead zone here in the middle, but it's above zero. And, I'm going to put on a huge amount of this trade." And this is a big no-no, okay? This trade looks good when the volatility is higher. But when they drop the volatility out of the market on Thursday morning and then again on Friday, this trade is not going to look very good. And so how do I know that? How can I figure out whether the trade is going to look it's going to look good or not? And the answer is that you do your research on it, okay? You do your research and follow the trade. Put together trade together and then follow the trade and record the prices daily and see what happens to it as the market moves, right? So in this example, this is seemingly looks like a great trade. But as I've warned everybody, these dead zones can be deadly. They can be deadly. And these dead zones act as a situation that keeps this entire trade from really showing a profit of any kind of significance throughout the week. Okay. Thursday afternoon, this was one day out. Okay. One day out. And in this particular scenario, SPY was trading at 321, and this trade had an open profit of $15 right at the profit peak. Okay, one day out, and this trade only had an open position profit of $15, and it's right at the profit peak. Now, that is a profit, all right, I'll give you that, but that's at the profit peak. And if we're one day out and it's only showing a $15 profit at the profit peak, what's it going to be showing in the middle of the dead zone one day out? Is it going to be negative, or is it going to be above zero? No, it's going to show, it's most likely going to show a loss. So here's the trade. Same trade, okay? That was showing for a debit of 17 cents. The trade that I showed, debit of 17 cents. That means the risk to the way it was structured, the risk to the downside was $17, the risk to the upside was $17. That's it. But the real risk was in the dead zone. And what I want you to see here is I want you to see this trade if we go in the money or out of the money. And this is the same trade one day out that is in the money or out of the money. And so if it goes in the money by 5 and 4 points respectively, you're talking about a credit of 5 and a credit of 2. Credit of 5 and a credit of 2. Now, if it's trading at a credit of 5 and a credit of 2, and I entered at a debit of 17, what am I showing? I'm showing a loss. Okay, I'm showing a loss of about $20. So what I'm giving you here, this is the exact same trade combination. And trade 1, trade 2 is 5 points out of the money, and trade 3, trade 4 is 4 points, or excuse me, in the money. Same thing, only one day out. So in other words, where is this trade going to be if the market moves up a few points, 4 or 5 points, right? So let's say 324, 325. Where's this trade going to be one day out? And this is what reflects where the price of that trade is going to be one day out. My bearish is a credit of 63. My bullish is 58. That means it's a credit of 5. If I got in at a debit of 17, I'm losing $23. If it's in the money by only 4 points, you'll notice there's not much of a difference in the price. It's only 3 cents difference in the price by moving the entire market by 1 point. Okay, so this is again one day out, same exact trade, one day out. 41 cent credit versus a 39 cent debit on the bullish. Okay, so if I entered in at 17 1 week before, if I entered in a debit of 17 1 week before, and now it's a week later, and the market has moved to where this trade is in the money by 4 points and it's trading at a credit of 2, I'm losing $19. Right? No profit opportunity. And that's all you have to do to understand, oh, okay, this trade probably isn't that great of a trade. Here's the same trade that's out of the money by 2 points, okay? Out of the money by 2 points. And what's it at? Well, the bearish is at a debit of 17 and the bullish is at a debit of 6, right? So the market moved down. And so what's this one trading at? It's trading at a debit of 11. I entered at a debit of 17 a week before. Are you following me on this? So no matter whether the market moves up or down, 1 day out, I'm losing money from entering this trade a week before. So it is a situation that is not good. Now, here is the trade for the following week. Okay, 5 points in the money, 4 points in the money, respectively. You can get into the same trade last Thursday for this coming Friday. All right, you could get into the same trade for a total debit of 39 cents on the first one. That's 5 points in the money. And if it was 4 points in the money, you get a total debit of 27 cents. And so, again, by this Thursday, guess what? These are probably going to be at a small credit, which means I'll be losing $39 and probably losing somewhere around $27 with this trade. And this is the trade that we're talking about, by the way. Okay. Now, if it's not making money any day of the week, regardless of whether the market moves up or down by Thursday, and that means that the final profit potential is going to be on Friday, and it's not going to be that great because you have to wait until the last second on this profit peak before you actually realize the gain. So there are the market in this instance was trading at a profit peak, and the trade was trading at a $15 profit on Thursday, but that's as far as it goes. All right. So again, same trade, 2 points in the money, 7-point range, same price, no profit potential anywhere during the life of the trade. Entered this one in at a $17 debit, and the best you got here is a $3 debit, which means you lost money. So that's the proper way, I should say, of determining whether you should take a trade or not. The more exit opportunities you have during the week, the higher probability you have of being successful with this trade, even when the volatility drops off. All right, so here is a very similar trade to what we were looking at. It is the bearish is actually the bottom three, a 321, 324, 324. All right, and that's the bearish. And then the bullish is a 331, 332, long two 330s. That's the bullish side. If we want to, here, we can do this to make sure everybody's on the same page. So group one will be the bullish, group two will be the bearish. And we will go up here. Which one is a SPY 7? So we'll go here. All right. So here you can see the bearish is in the red, bullish is in the purple, if you will, and the blue is the combined trade, right? So this is very, very similar. And we have a dead zone, and the dead zone is above the zero line. And this is, of course, trading at a credit of 2 right now. And this credit of 2 means that there's no risk to the downside and there's no risk to the upside because of the relationship between all of these 6 different strikes. So what's the most telltale sign that this trade might be a problem? What's the most telltale sign? The dead zone is the telltale sign. If you're in a dead zone combined with 4 longs, what do I say? Give at least 50 cents. Give at least 50 cents on the longs. Margin of error on the longs per long, so that's 4, because you have 2 longs here and 2 longs in the bearish and 2 longs in the bullish. That's 4 times 50, $200, and this is showing a profit of about $50 at the bottom of the dead zone. That means that if they drop the volatility, and they will, you're talking about that dead zone dropping to maybe $100 to $150. Now, it's not quite like that because the 330s can only drop 74 cents completely, right? Um, so I'm talking about the projection being wrong by 50 cents, not the price dropping by 50 cents. I'm talking about the projection. And on this one, leg 3 is projected to make 44 cents if the market's at 327.50. And since I'm in two of them, that would be 22 cents a piece. It's projecting the 330 to be worth almost about 94 cents. Okay, leg 3, total profit projection at 327.50. It's 2.5 points out of the money is 44 cents. I'm in two of them, so it's 44 cents divided by 2. That's 22 cents added on to my entry price right here of 74 cents. Right, so that's actually 96 cents is what it's projecting the 330s to be worth when the market's trading at 327.50. That's not going to happen. And by the way, it is what it is worth right now. I mean, if the unemployment report didn't come out on Thursday morning, if there's some other reason for this, then we could count on it. But we know what the reason is, and so we know we can't count on it. So you drop it down here, and this is really a much more accurate picture of what we're looking at. And what I did was I dropped the volatility down on the 330s to 12, and on the 324s to 13, and I could probably drop them down a little bit more based on everything that's going on. And so if I leave this trade alone, we're looking at maybe at the profit peak $100 right before the close if the market's right at the profit peak. And everywhere else, this is highly unlikely. This bullish, the market moving up to 332, 331, I might make $100 at the very last minute if the market moves up there. Probably not, probably going to drop out a little bit more if the market were to move all the way up there. But this is a highly unlikely area. And so really what I'm dealing with is from about 328 down to about 315. That would be a high probability range. 315 to 328. It's a high probability range. And what I have is I have a negative EMR almost the entire way through. And so this is not a trade that I want to take. And what I mean by negative EMR, I mean if the market moves down, let's say by a point, then I might make 75, 80 bucks. If the market moves up a point, I may lose, 50, 60, $75. And so it's very, very close. Beyond that, if it moves up more than that, I'm going to lose almost 100 bucks. I'm going to make something less than $100. Right? I'm going to lose 100 bucks. I'm going to make something less than $100 on the other side. That's a negative EMR. I go over that in the seminar. I don't want to spend a lot of time on that. But let's bring this down to a practical, what are we doing here? How do you compare these? Well, here is the trade that I basically had on the graph. And you can see here it's a credit of 95 on the bearish, and the market's trading almost at 324 now, so that's actually in the money. And the bullish is at 99. And so I have a debit of about 5 cents here, 6 cents, okay? This expires this coming Friday. And the total, if you add up these two, order number 1 is bearish, order number 2 is bullish. If you add up the total of these, you're talking about a debit of about 5 or 6 cents. And so how do I know whether that's a good price or not? Well, you're going to watch this thing, and you're going to record it. You're going to record the price at the end of every day. And if you can record it more, record it more. Record it on the open of every day and record it on the close of every day before you take this trade. If you uncover a pattern you think it's going to be profitable, this is the process you go through. Okay, you record the price and you just see. Now, my shortcut is that I just go ahead and look at the price currently going out an extra week. Okay, this is going out an extra week. Instead of 724, 727, it's the same exact trade on 731 and 83. My bearish is order number 3, my bullish is order number 4. My bearish is at 119, my bullish is at 136, 135. So guess where that is? That's at a debit of 15 cents, right? So if I already get into this trade today, both of the bearish and the bullish, at a debit of 15 cents, where can I expect this to be if the market goes nowhere in 1 week? I can expect it to be at a debit of about 5 cents. So I will be losing about 10 cents. This trade has no time value, has no time decay value in it, period. And that's how you know. And then on Thursday, guess what? I'm going to take a look at this trade. Obviously, on Thursday, I'm going to be interested in where it's at on Wednesday afternoon, and then on Thursday morning, and then on Thursday afternoon, and then Friday morning and Friday evening, or Friday at the close. Those are the critical pieces of data. All right, so then going one more, if I want to go out of the money instead of in the money because the market has moved up, or maybe less, let's say at the money. So now my bearish trade is actually at the money because it's a 323. So it's almost at the money. The market's trading at 323.80. So 323, 326, 326, that's my bearish. And I just move my bullish up by 2 strikes as well. And what is my cost? It's almost the same. It's actually a credit of 1 cent. Okay. And this is 724, 724, 727 on both of these. Okay. So it doesn't matter whether I go in the money with this, whether I go out of the money with this, whether I go 1 week out, whether I go 2 weeks out, whether I go 1 day out. The price is very, very similar in all of those cases. I have no opportunity to exit this at a profit. And some of you are putting together these trades having not recorded them or had any experience with them or anything. And believe me, I've put together some trades before and they not turn out at all what I thought they were going to, because I did not go through the process of knowing how the trade was going to react throughout the week based on market movement and time decay. All right, so that's the rule. And I'm going to bring that rule up again because it is a principle that you absolutely need to absolutely put into place with your trading. Don't ever take a trade that you don't know how it is going to react throughout the week based on price movement and the passage of time. This will keep you out of some not very good trades. Just requiring yourself to go through the process, and you don't have to go through it very many times. If you go through it once and it doesn't offer very many opportunities to exit at a profit, then watching it another week is not going to change anything. In fact, as the market is moving up, you can probably expect that to get worse because the volatility is going to continue to drop as the market moves up in these trades. Okay. So hopefully that will clear things up. The other thing that I saw was entirely too many long positions to create, this graph here that at first looks, fairly good. Here, let me turn those off. At first, the graph looks fairly good. No risk to the downside, no risk to the upside. Who doesn't want to take that trade? But the dead zone is dragging. And I will see some trades that look like this with like 12, 13, 14, 15 longs. and they've put together all these different legs and these different patterns, and they've put them all together, and they've got 15 longs to have this nice looking $100 profitable graph right across the board. If it takes 15 longs to put together a $100 profit, man, you flee from that thing. Run as fast as you can. All right. So, what's the best way to actually avoid this kind of stuff? Well, the best way to actually avoid this kind of stuff is to not start off by putting all these complex trades together. I know it's a temptation, and I know I talk about, you can do this, or you can do that, or you can do this, or you can do that. But the bottom line is you have to keep it simple to begin with. Prove that what you're doing is working and how you're doing it is working, and then go to the next step and make it more efficient, or make it, enhance the trade, or, profit stack, or whatever it is, address the dead zone. I talk about that a lot. You're going to want to address the dead zone. Well, some of these trades, you're not given an opportunity to address the dead zone because the market's just not moving enough for you to address the dead zone. And so we get into a trade like this, and you're like, okay, well, I'll take this trade, but if the market moves up to like 327 or 328, then I'm going to sell another one, or I'm going to put on another trade, or I'm going to put on a bearish trade at that point. Well, the problem is that's a great plan, but what if this thing moves up on Friday? You don't have an opportunity to do anything come Friday, or sometimes even Thursday. If it waits until Thursday afternoon to move up to 327, you're going to be in trouble. All right, most of the time. And so, whereas I am a fan, and I do, when I create trades that have dead zones, and I do have a plan to address the dead zone, but you have to understand that you may not have the opportunity to address the dead zone. And there are some trades where you have a lower opportunity than others, or a lower probability of addressing the dead zone than others. So, again, start off with one trade, one simple, and I say simple, one pattern, and you can use the the $1 million pattern, and then take a small profit, for several weeks, just doing the same thing. Boom, 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 and then go to the next step, improve it. Watch some of these other patterns, record the prices on these other patterns, and it'll be tremendous for learning experience, as well as keep you out of some of these traps. All right. So let's take a look at what we are in today and what I got in last week. I gave kind of a different variation of there's several basic variations of the $1 million pattern. And it's the bearish is almost the same. It's where I'm short one strike, go 4 points higher, and I'm short the second strike, and then my long strike is 1 point above my highest short. So here, this is a 323, 326, 327. Right, short the 323, short the 326, and then long 2 327s. Now I'm happy with this trade by itself sometimes. And the reason I'm happy for this trade, to have this trade by itself sometimes, is because I know that if the market goes nowhere, I'm going to make money on this trade. If the market moves up a little bit, I'm going to make money on this trade. If the market moves down, I know I'm going to make money on this trade. And I'm going to have several opportunities throughout the week to do that. Right? So the issue with this particular trade is what? The issue is the risk to the upside, because the risk to the upside is basically $400 on this trade. Now, granted, the market's going to have to make a pretty significant move to the upside for that to happen, but we live in weird times. Congress comes out and passes a bill, stimulus bill, who knows whether the market's going to act irrationally and move up to 335. It could. Not probable, but it could. Right? So that's the issue with just this trade. But I know how it reacts throughout the week. And I know that I'm going to have an opportunity I'm most likely going to have an opportunity. If I were to do nothing but put this trade on, most likely have an opportunity to get out at a profit during the week or put on a bullish trade, right? And so this is, of course, the bullish trade. And I was not filled on this trade immediately. So I was filled on the a credit of 101 on this bearish trade. And I had that as a limit. And then I had this trade on at a $60 debit. And of course, two of them in place after that. And I did not get filled on those until this morning when the market opened, moved down a little bit, and I was able to get filled on those. And this entire trade is a debit of 20. It's one of several similar trades. Overall, I have a net credit on everything, but on this particular trade, it was at a debit of 20, and there's a reason for that. And I want to discuss this a little bit more because I think there's a little bit of confusion on how that works. Because there was a question, and then I saw this in one of the trades as well that a client sent me. So this is a bullish trade, and the bullish trade is going to start making money fairly quickly. This is, of course, as the market is, or excuse me, on the last day of the trade, which is 724. As of right now, the market is up from this morning, and this trade is actually making money. It's at 80 cents right now. But my bearish that I got into on Friday, or was it Thursday? I don't even remember now. I get the 2 days mixed up. But I was filled at a buck credit on that day, and right now it's at a $1.27 credit, and it is just slightly, or I'm sorry, $1.40 credit, and it is just slightly in the money. And so we're trading at 323.75, and my first strike is at 323. So I know I'm going to be making money on this trade by the end of the week. So if the market goes nowhere, I know I'm going to be fine. I will be losing money on this trade, but right now I'm also making 20 cents a piece, so I'm making 40 cents on it, losing 40 cents on this one. So as of right now, I don't have the opportunity to exit this trade for a profit, but it's only Monday, right? So it's not necessarily enough time for that to happen. This is the trade that is combined, okay? 20-cent debit. So there is a small risk to the downside, but I have a large range where this is profitable and a smaller profit zone at around 330, just to make sure that I am given an opportunity to exit at a profit if the market begins to actually move much higher than it is right now. Again, trading almost at 324 right now. So still got a ways to go on that one, but I should be able to exit this on Wednesday afternoon. Pretty high probability of exiting this on Wednesday afternoon, unless the market tanks, at which point I could lose $20 on this particular setup. Okay. Now, I did not get into the bullish immediately for a couple of reasons. Number one, this bearish was out of the money. And so since the bearish was out of the money at the time that I entered it, I knew the market was going to have to move higher. Okay, and the market was trading around 321-ish when this was filled. And so I was still below my profit peak on this one. And so what that does is it gives me a little bit of room, buffer, if you will, for the market to move up, and for me to get filled on the bullish, which I put in at a debit of 60, and it was trading at about 68, 69 at the time that I was filled on my bearish. Again, this morning, market come down, and this was filled two of them giving me that debit. You'll notice the structure. The 327 is the long on the bearish, and the 328 is the long on the bullish, and that's only one strike difference away. And I did this for a couple of reasons. You can do this two strikes away, so you can have it where the long on the bullish is a 329, and then your short's a 331, and that can be your bullish. And there's nothing wrong with that. However, the more we get to these higher prices, the more the volatility is going to drag on these. And so I am being a little bit more cautious by tightening up the dead zones. The tighter I can have the dead zones to where there's almost no lag, the better off the trade is going to be. All right, so I can go in here and I can stress test this thing. And I know that I'm going to have a very, very high probability of being able to exit at a profit on this trade because I'm not going to hold on to it until the last day. 328, so I will pull those down a bit. So if I were to hold on to this until the last minute, we're talking about profit potential dropping, and it's actually going to drop more than that. There we go. That's a worst case scenario of the market collapsing, the volatility collapsing on the last day, and the market at 327, 328. It's not going to be quite that bad because those will be at the money and slightly in the money in this dead zone. But again, this is holding on to the last day. I will have an open position profit opportunity between now and then. Now, if I were to go one more out on one more strike out on the long, and for whatever reason I get stuck with this until the last day, okay, now I have a situation where without dropping the volatility, you can see here I've got 4 longs and the dead zone is just over $100, actually about $135. So if I say give it $50 a piece, I'm actually looking at this dead zone drop below the zero line. All right, and that's because I went out 331, 329. I also created a credit on this trade of 23 cents. And so there is some benefit to doing this, but you just have to be aware that if you hold on to this until the last day, you may get caught in this dead zone and actually lose a little bit of money. So this is not a situation where it's just absolutely foolproof. Hopefully, what happens is if it moves up here, it moves up here Wednesday, Tuesday, Wednesday, gives you an opportunity to exit the trade. If it doesn't, and it waits until Thursday, you should have an opportunity to exit the trade at a profit before it ever gets up into the second dead zone. All right. Again, I like the fact that the profit peak here, the last profit peak, is above the previous profit peaks, which is really what kind of pulls this thing up going into Thursday and Friday. And then I also like the fact that there is a 23-cent credit. But I may not have a very big profit with this thing. If the market moves up to 327, let's say Wednesday afternoon, I may not have a very big profit on this at all. And I probably will go ahead and exit at that point. Depending on where my bullish trades are at and whatnot. Okay, and that's again going a little bit further out with the long. This is not the best bullish trade. It just is the easiest bullish trade to put in here. A better bullish trade is one where you are looking at a bigger profit potential. at the peak and above it. And so on this one, for example, this is a 333, 332. Those are the shorts, and then two 331s. And that's going for 75 cents, but I would want two of them, and that would actually give me a bigger debit on the trade. So I would have to go a little bit further out. But those are actually going to increase in value a little bit faster than just the straight debit spread, 1-1 debit spread. But I actually compare the bullish trades extensively in the bullish section of the seminar. Okay, so having said that, what do we have? If you want to get into a trade right now, you could actually get into a very similar trade right now that we got into on Friday or Thursday, because the prices are not that far off, again, because they're holding them up based on the economic reports. And I didn't look at Market Watch, the economic calendar, to see if there's anything else going on this week, but that would also be something that you might want to look at. So what I'm gonna do is I'm going to bring in trade partner here. We'll put together a trade. Let's see here. And I will be willing, again, to be patient on my bullish trades, just simply because that the market is trading up. I don't want to be, I don't want to be reckless with how I do it, but I also am willing to be patient. All right, so let's go. This is the TPO live call for our live TPO signals, I should say. 4720-20. There we go. So first of all, we're going to be looking at 724 and 727. And we'll increase that, collapse the chart. All right, so market's trading almost at 324. So let's just take a look at the 324, 327, and then 328. See what kind of credit it's trading for. $1.26. That's pretty good, considering, yeah, if that holds. $1.18. So $1.20. That's not bad. And then we can add an order if we want to go 1 point where the long is above this one. It'd be a 329 long and 331 short. So we'll go sell and 29. This is again the easy bullish trade, and it's trading at 65-ish, 64-ish. So guess what I would do with this one? I would put it in at 120, and then 60 is what I will do with this. And I may not get filled on any of them, but that's, so let's see here. Credit of 120. A day order, and then add group. If order 1 is filled, then I'm going to click on order 2 for a debit of 0.60. And I'm going to do 2 of those. Now, if I wanted to, I could do a debit of 65, credit of 115, and I would have a 1-to-1, and then put in a debit of 55 or 50 on the second one. And that way, if the market moves down at all, or if the market just stagnates right here for a couple of days, I should get filled on another bullish, or a day, or tomorrow, I should get filled on another bullish, and that would be fine. Okay, let's take a look at what we can get for about the same price with the 112 bullish. So we'll go add order, and we'll say, let's do a more simple one. Let's do 330, 332, and a 330. and do 2 of the 330s, and that one is going for 78. This one is not bad at all because you've got the short strike, well, not 83. So you got the short strike that is only 2 points above the long of the bearish. But the price of this, you're looking at 83 cents. Be very, very difficult to wait long enough to get a credit. So I would probably look at a 331. I could just do this. So we can compare prices. So 331 and 333. This is one of my go-to bullish patterns. And you'll notice the long is at the same strike as, whoops, 331. The long is at the same strike as the lowest short. Okay, now that one's trading at 67 debit, assuming that's going to hold. So we've got almost the same thing with these two bullish here. So I can go, if I wanted to, I could go, get this one at 60 as well. Let's just do this, just for the heck of it, to see which one fills first. Timing. I already know the order 4 will actually perform a little bit better. If order 1 is filled, execute order 4 at a debit of, we'll do that one at 60 as well. And so now I'll have one bullish of order 3 and one bullish, or no, order 2, excuse me, and then one bullish of order 4 working. And I'm doing this not because this is a signal, but because an official signal, but because it will be something that we can look at on Thursday and learn a little bit about how these bullish trades work, both in price with regard to which one will be filled first, and I'll record the time of each of them being filled. And I'm going to do this GTC and GTC. And I'll give this till today and today only. All right, so we'll do this. Save system. We're trading at 122 now. It's taking forever. My internet has been super slow today. No storms, just super slow internet. We're trading at 122. And I hope it didn't just, all right. Trading 120, we'll just keep it at that. Okay, turn it on. So technically, I'm in this scenario, I'm willing to risk the bearish trade. If I'm filled on the bearish trade and then I'm not filled on either bullish trade, I am willing to risk the bearish trade on this. So don't do this unless you're willing to risk the bearish trade on this one, and then go from there. Okay. The question that I had the other day was, hey, what if I put one of these on and I can't get, let's say I look at this bullish here and I can't get it for what would be 60 cents. I can just move this to a 332, 330, short 332 and a long 330 and do 2 of those. And I would absolutely get a credit. Well, why would I not want to do that? I'll tell you why you wouldn't want to do that. And it's because of what I just showed you here. Unless you're willing to accept the dead zone of this bullish trade being further away from the bearish trade. You have to accept this dead zone. You have to accept the fact that you'll have a smaller risk on a trade. Now, granted, you'll create a credit on this trade. If we move it down here, you'll create a credit on this trade, right? If you were to move the strikes up further by 1. but you do have to deal with the dead zone. All right, I'll pull that one back here so you can see what I did. And hopefully, so I can't, here's the bullish. Here's order number 4 bullish. We did not use order number 3 bullish. We used order number 4 bullish. Okay. All right. I will take questions. Let's see here. Let's see. Waiting for the seminar to get here is like a kid waiting for Christmas. Yeah. All right. Do you have any strict rules for exiting these trades, like never exit in the last minutes if the market is up? The exit, so anybody here in real estate at all? I do some real estate stuff and do really well at it, actually. And there's a reason I do really well at it. And it's one reason only. And it's a rule that is absolutely applicable to trading. Okay, and that is you make money when you buy the property. That's the rule. You make money when you buy the property. You don't make money when you exit the property. You make money when you buy the property. What does that mean? It means that you entered at a good price so that exiting is not this situation where you have to have the right setup at the right time and wait for the moon and the stars to all align like they were this week in order to exit. The better your entry is, the more opportunities you will have for the exit to do well. So my strict rule for, I do not have a strict rule for exiting. My exiting guidelines and principles are basically what we went over today, and that is make sure you have the opportunity to exit some of these at a profit throughout the week. Let's see. Once I get a trade placed, I feel like I'm day trading and I do not know how to use limit orders or alerts to manage my trades. Hence, I stare at the monitor and just out knowing what to do. Keith, do me a favor and shoot me an email. And, all right, and you know what would actually be best? No, shoot me an email. Shoot me an email and tell me the exact process, for example, that you went through this week. And that will help me to, because there's no day trading. There's only, so for example, today, prices are kind of weird right now in that, we're trading higher and we've got Thursday looming and prices are kind of weird. So in this case, I'm willing to accept the risk on the bearish. If you're not willing to accept the risk on the bearish, get into one of the bullish first and then wait for the bearish. You just have to be willing to accept the risk on one of the bullish, right? So most of the time when you're doing this early enough, like Mondays, we're getting close to the end of when I want to do this, right? Tuesday, there have been times where I've entered into trades on Tuesday that that close on Friday. But the more I get into this, the more I'm willing to go in at like Thursday or Friday, the week before, with the majority of my position, because I know I'm going to have a lot of opportunities to get my entire trade. Mark, it's tough to say when manually lowering the volatility in the longs and PDS trader, what number should you lower it to? It's tough to say because you don't know exactly what's going to happen. So what I do is I take a look at what the value of the Monday long was at the close on Friday. For example, the at the money Monday long at the close on Friday was actually at about 160. And so that's pretty much what I'm targeting for. knowing that in most cases I'm not going to be waiting until the last minute to exit. Should we consider a different day combo like Monday, Wednesday, or Wednesday, Friday? I cover these a little bit more in the seminar, Robert. The problem with the other combinations is that you can't necessarily get credits on some of the combinations. For example, so if I put the same exact trade on at a credit for Friday, Monday, I may be able to put that same trade on at a debit. If I put it on for, let's say, a credit of 5 cents, I may end up putting it on for a debit of 30 cents if I use Monday, Wednesday, Wednesday, Friday, which is fine if you're willing to accept the risk. But what my suggestion, you don't need to wait for me or the seminar to do this. My suggestion is put together a couple of these trades, exactly the same strikes, same relationships, based on Monday, Wednesday, Wednesday, Friday, and then watch them. And you'll see exactly what I'm talking about, because they are profitable, but you're not getting as good of a price. But on the flip side, the volatility is remaining higher in those longs. Okay. As we get closer to expiration, do the longs decrease in value at similar rate as the shorts? In light of the answer, when is it best to close out the position? So I thought I answered this a couple of times, Mark, on the last session, so maybe it's not clear. The longs, so as we get into Thursday and Friday, we're dealing with extrinsic value. And what happens is that the volatility comes out, the uncertainty comes out, I should say, and all of a sudden now we have longs that are worth, $1.50, and the shorts that are worth 50 cents. Well, by logic, if you look at that logically, how much can the longs lose versus how much can the shorts lose, or in value, right? Or better put, how much we have Friday options that are, have 50 cents of extrinsic value, and Monday options that have $1.50 extrinsic value. Which option has more value to lose? And so, it's really based on the value. If I have shorts that have about the same value as the longs, then my shorts are going to lose value faster than my longs on Friday. If the longs have more value than my shorts, then it very well may be that the longs, depending on how much more value they are than the shorts, can lose value faster than my shorts. Not at a rate, not at a percentage basis, which is kind of where some of the Greeks lead you astray, but on the actual price basis. If I have $1.50 that it can drop versus 50, then there's quite a bit more in that. All right, so I had another question on the Wednesday, Friday versus Monday, Wednesday. So I would, again, that's a great suggestion on that. Back testing is way, Phil, great question. And back testing is way, way, way overrated on this. However, your question with regard to overall back testing is overrated, because you have such different scenarios, so many different conditions going on at various different times of the year, various different times of the month, various different times of market action, and you just don't get an accurate picture. However, doing a back testing for the previous trade is much more accurate. And yes, so Trade Partner, we're actually creating a scenario in Trade Partner, not PDS Trader, that will watch those for you. PDS Trader will also do it on a different scale, and so yes, that information is coming, but the overall back testing I've found to be very, very unreliable. Let's see. Yes, the seminar is being recorded, and so you will have the access to the recording. How do we know what numbers to assign to the long leg volatility numbers? So that was the same question I just answered. Let me see here. I'm going to pull something up. All right, so on this one, 323, let's take a look at this one. Look at leg one. If the market, my entry price is 278. Whoops, look at leg three, sorry. My entry price is 159. And it's showing, and there's two of them, and it's showing a net loss on the long leg if the market closes right at 323, basically. My long leg is looking at losing $200 total. That's $1 a piece. That means that it's projecting my 327s to be worth basically 50 cents on this. Now, the projection here are 59 cents. Okay, hopefully everybody sees that. The projection here at $1.98 loss on leg three divided by 2 is $1 a piece, more or less, 99 cents, right? $1 a piece. Subtract the dollar from my entry price. That means the projection of my price of my 327, and I just got filled on my bearish, by the way. But the projection on my 327 is at 50 cents. Now, guess what? At 50 cents, the worst that can happen there is that go to zero, right? So on those two legs, I can't lose more than 50 cents. It can't be wrong by more than 50 cents because it's out of the money and it's only being projected to be worth about 50 cents, 59 cents, right? So that one is probably, it's not going to be accurate because that will be 323. That will be 4 points out of the money. Yeah, so I'm going to put that at 13. And now that projection is at, let's see here, a loss of 260. That's a buck 30. Now it's projecting the longs to be at 30 cents. So that's probably pretty accurate. Okay. If I go to 327 and look at leg three, now leg three is projected to lose, excuse me. Now the leg three is projected to lose 10 cents based on my drop in volatility. That means at 327 at the money, it's being projected at 154, and that's really accurate on that projection because I pegged it at 160. Right, last week's it was 160, a little over 160, and so that should be that's how you do that. You just kind of if it's at 12%, 160 will, or 13% will create a scenario where it's worth 155. Okay, so there's no exact science to that. All right. You say go market when it's saying order. First, and then the market went lower right away, and I was able to get the bearish. Let's see. Jeff, so that is basically saying, hey, I didn't go in market last week, and then the last couple of times I entered the bullish first, and then the market went lower right away, and I wasn't able to get the bearish until the credit dropped by 50 cents. Even if I got ripped off by 8 cents, it would have been better in those scenarios. So, I totally understand that, and it is definitely something that you can consider. I would not go if you do something like that. If you absolutely have to get filled, I get it. Don't go market order with both of them. go market order with one, and then once it's filled, then start playing the bearish. Um, and that's a better way to do it if you absolutely have to get filled. The two-strike difference between the bearish and the bullish, there's not a steep dead zone there, but it does exist. It's not steep at all. This is, let me show you the dead zone going 2 strikes out. This is it. Or going 1 strike a little bit further out. This is it. And so it's not a steep dead zone, but it does exist. All right, let's see. If my long didn't get filled at 60, what would I have done? I would have held it in there because I'm still basically, my bearish right now is at a profitable level. It's not a profit. It's at 154. It's actually losing, but it's at a profitable level, meaning that if the market stays here through the rest of the week and that's it, I will make money. Clarifying, did you wait until the market hit the first profit peak on the bearish trade until you put the bullish trade on? Thanks. No, I did not. The market was 2 points away when I put the first bearish trade on. And that was last week. I'm being feed to death by AB. I purchased trade here for opening an account for National from New Zealand, but they were not. I do have, I need to reach out to them because they were accepting, Trade Here was accepting applications from foreigners before, and I don't know if they just stopped or not, but I do know the owner, so I'll reach out and find out what the deal is on that. So for those of you waiting for TD Ameritrade in Trade Partner, the reason that there's such a holdup is that we want to be able to quickly add on different brokers, and so we actually had to create an entire template, if you will, in order to get us into that. And so it's a lot of extra work, but they are, yeah, I'm on them almost daily. Let's see, if the long call is not very close to 18 money, Friday it's going to become virtually worthless. If the long call is not very close to at the money, come Friday, it's going to become virtually worthless. The bug. The volatility changes every day, Keith. So and it totally depends on the trade that you're putting on. If the ATM on Friday, or excuse me, the profit peak is not going to drop to near zero. A profit peak is a profit peak. It's not going to drop to near zero unless you have a crazy distance between the shorts and the longs. And we use the standard calculations for the projections, which is why I'm changing it with the new PDS trader. I'm creating my own. Do you always need a bearish trade and a bullish trade? Do you take into consideration direction of the market and of SPY? So you can, Theodore, but you don't want to turn this into a timing model. So I would be very careful. You you pull that out. You pull the 98% out of the whole equation when you start putting it into a timing model. Let's see. Troy, if you look on YouTube, you'll actually find some PDS Trader videos that will that show you how the action group settings work. I also do cover PDS Trader in the seminar as well, and that one will be made available to everyone, whether you're in the seminar or not, because it's really not. It's just kind of a bonus in the seminar. In fact, I may not even use one of the seminar sessions to do it. I may just add it as a recording. What if you were to use slightly deeper in the money options? If you use slightly deeper in the money options, you create a bigger credit on the bearish. And if you do that, then you also have a lower probability of success because the market doesn't have to move as far to the upside. Let's see, Ryan, real estate is all I do, and this. Great. I'd be interested in hearing what you do in real estate. Ryan, you should shoot me an email. We can swap ideas there. Really, really good session about the exits. Great, Aaron. Can you build a simple trade with $150 max risk? So the trade that we may not get filled, let's see where we're at because the market is moving higher. Seems that the afternoon on Monday and well, Monday, it seems like it's consistently seen the market make a move during the session. So, all right, let's see here. Next call will be Thursday at 2 p.m. Eastern. That is correct. With order 3, I have 2 longs and 3 shorts. No, not true. I'm not using order 3, first of all. I chose to use order 4 and 2 for my bullish. Order 3 is 1 short, 2 bullish. And it's now at a debit of 96 cents. So I'm not sure what you're looking at as far as credit 37. Over South Africa and trade here does not want to open an account for me. I paid a lifetime package. How can I get TP to work? Joe, what about TD Ameritrade? Are you able to open with TD Ameritrade? To just compare the trades. Let me look into that, Joe. Let me look at and see if we can't put that into the free version. Price data. I don't know that we can, but I'll look into it. The recordings of the last few calls should be posted. If they're not, well, I guess I'll have to check. But yeah, they should be posted. Right. I'm going to suggest that you, Tim, that's a long answer because that's what I spent most of today on. So I'm going to suggest going through today's recording when it's posted. So generally, if you just, if you go to the link that you were sent to sign up for this thing in the first place, within a few hours, it usually points you to the recording. That's what I'm being told here. Okay, passive entered a second bullish. If I enter a second bullish several days after I enter the first one, the consequences are, or the circumstances, what circumstances would I do that? I would do that now because the market's trading so high up, and I know that the prices are going to come down. So I would actually do that now. And I have done that, by the way, in several of my accounts. As an Australian, Schwab. Philip, man, if you're trading with Schwab, man, it will kill you. It'll be very difficult. Hopefully the TD Ameritrade will be much better for you. I will give Trader another call because I know I don't know if they must have run into something regulation wise. Is there some sort of long short ratio we can use to know when it is better to close the position, where we could lose more on the longs versus the shorts? Dave, that's a really good question. It's not one that's easily answered, and other than what I've already given, what you're asking is for something more specific, and the problem is that every week is different. The market moves down, it's going to be different than it was this week because volatility will increase. If the market moves up again, it'll be different than it was this week because volatility will decrease. Let me spend some time thinking about that question, see if there's something better that I can give you along those lines. But the best thing is to just follow the trade during the week and see where the prices are, which that's the best thing that you can do. If not filled on the other half of the trade, at what point does it become a gamble versus strategy? So, Ryan, that's a great question, and it's never a gamble with either of these trades because if you can put the probabilities in your favor, then it's not a gamble. If the probabilities are not in your favor and you're just hoping that the market makes a move in order to put the probabilities in your favor, then that's a gamble. All right. So with the bearish, the probabilities, for example, if I'm filled on only the bearish, the probabilities are in my favor. They're just not in my favor by that much, right? But they are still in my favor. And if I have the bullish, depending on what bullish I put on, if I put on the bullish first and it's way out of the money, then it's going to be close. It's going to be a 50-50. It'll be a 50-50 type deal where the probabilities are not quite in my favor, or maybe they are. If it's closer, then I probably have a slight probability that is in my favor, right? So the key behind these two is to make sure that if you get into one first and you're stuck with that the probabilities with that one are in your favor, and with the bearish, they absolutely are. The bearish neutral, they absolutely are. But it's not 98%, right? So I think that's where you might be getting confused. You can put together the same exact pattern with puts, but you can't do it on the reverse to where the risk is to the downside with puts because there's actually higher volatility in the lower puts. Let's see. Oh, I see. So for hedging with stock patterns, yes, you absolutely can use some of these as a type of hedge for a stock pattern. In the TPO PDF guide, I show a single leg or a singles trade bullish bearish structure, reduced overall trade risk. Is that good to focus on for beginners? So the problem with the single trade where I have a bearish and a bullish, it's two legs apiece in the single trade, so you can place it all at once. The problem with those is that those are especially susceptible uh, um, uh, to the volatility drops. And so the probabilities are still in your favor, but you got to be careful with how you put them together. Probabilities are still in your favor, but they're not as high in your favor as, for example, if you are able to put together these bearish and bullish trades. And so if you really want a higher probability of getting into these bearish and bullish trades, much closer together, I would focus on entering them on Thursday and Friday, the week before, as opposed to, for example, on Monday. Where, as you can see, we're having trouble getting these at a decent price, and especially with the market now trading up a point higher than when I placed the order. Let's see. If a three-legged bearish trade is more efficient than a two-legged bearish trade, and a three-legged bullish trade is more efficient. Yeah, the three-legged trades are more efficient, which is why I do them, which is why I said a 2-2 is just not as good. Yeah, you can put two together, a bullish and a bearish with four legs, one single order, but it's just not as good. It's not as efficient. All right. Almost through the Q&As. Yes, Joe, you will be getting the blueprint. Use the option.net Explorer software that works with trade here. Michael, I don't know anything about option.net Explorer, so I can't give you any kind of advice on that one. I've never used it. Steve, for me to explain that again, you would need to go through, you'll need to watch the recording. I spent, what was it, 30 minutes? So I can't do it again because we're an hour and a half into this thing, but watch the recording. And if you have a specific question or questions, get them to me and I can address those after you watch the recording again. Let's see. Saying I would do more positions beyond trade 1 and 3. What is trying to ask? I guess I still don't know what you're trying to ask. So this is what I was filled on at $1.20. It's now at $1.50. I was not filled on my bullish. So here, this is now in the money by a point. Market's trading up. I am at risk for this bearish, for the risk associated with this bearish, since I've not been filled on the bullish. So I'm just going to be patient. I had the bullish at GTC orders. So I'll be patient and see what happens. And if by Wednesday, let's say I'm not in the bullish, but I'm in a small loss on the bearish, because the market, by the way, will have to continue moving up for me to still be at a loss on the bearish by Wednesday. If that's the case, then I would probably exit the bearish and take a small loss on the trade. If the market skyrockets, then I have to be willing to realize this risk. All right, so let's see. The $1 million, so I have a $1 million pattern. I just named one of the patterns $1 million pattern, and basically this is it. Only today, because of prices, we can't get filled at the same time, right? Even now, if I were to put these on, order number 1, credit 1, let's say I put it on at 150, I still can't get the bullish for 75, right? So I have, but it's the combination of these two that I call my $1 million pattern. And it's just one pattern. That's it. One pattern. We'll be going over several patterns in the seminar. DJ, yeah, you have a higher probability of taking a profit with a three-legged trade. That is correct. Versus some of the more simple two-legged trades. All right. So, Michael, I'm going to have you email that to me because it doesn't come in all at once, and I'd have to go through each of these and put the trades that you're talking about together. So just send me an email, send it to support at Payday Stocks, and tell them to forward it to me directly. All right. Looks like I got all the questions. And based on these questions, I know where I need to go for Thursday's call as well, and it also helps me need to know where I need to focus on one of my sessions for the seminar. So great feedback, great questions. So keep them coming. I appreciate it, and I will see you guys on Thursday.